Great. So welcome you all once again to today's section. Today we're going to look at the summary points of the IAS 12. So summary of IAS 12 income tax to solve more questions. And, so IAS 12 income tax. That is today's section. Right. Okay, so IAS 12 talks about income tax. Income tax. Basically, the tax is disclosed in the financial statement by companies. So income tax of what, corporations or the companies. That is it. So as usual, we should go through the objective and scope. Now the objective of this standard is to prescribe the correct accounting treatment of what, income tax or the income taxes for the entities. That is the main objective of the IAS 12. Now, there are so many types of taxes, but the one that we are interested in is the company tax or the corporate tax. Corporate tax. Or we also call it CIT, corporate income tax. Corporate income tax. That's the main focus of IAS 12. Now let's go straight. Now the income tax expense stated in every financial statement is made up of 3 items. And that is what we have to look out for. Good. So this IAS 12 just provides how we should arrive at the income tax expense for every company or corporation. That is all. So it's made up of 3 items. So income, in summary, income tax expense is made up of 3 items. You know the 3 items, and then you are done. Normally we call it C, U / O, and then the D, hat. So if I sum these 3 items together, I'll now get what? The income tax expense, which will be stated in the company's books, preferably the comprehensive income. So now it is your duty to know how we arrive at this. Okay. So let's see. Let's start. The C simple means the current year tax or the corporate tax. So current year tax. C means current year tax provision. It is also called corporate tax provision for the year. Why do we call it corporate tax provision? Because it's an estimate. So what you have estimated. Now the income tax, when you are preparing your financial statements, you cannot determine the final tax that you should pay. It's in the hands of the tax authorities. So you make what you call just a mere provision so that they will confirm it for you after you have prepared the financial statement. Okay. So that is. So how do we arrive at this? So the current year tax provision is nothing by is the profit that we had, the profit before tax times the tax rate. Good. That is the accounting profit times the tax rate, because this is just a provision in the book. That is all. We are done. Now, the question is, where do we get this figure from? We get it from two places. You look at the first one, and then where you pick this figure from will determine the accounting treatment. Okay. So let's see something like this. Now we said that if the current year tax in a trial balance, you can have it in a trial balance, maybe. In a trial balance, the name will be tax computed on taxable profit. That's the name that we will call it. And the treatment is only one. After you bringing it here, it ends there. We are done. So tax computed on taxable profit, or the income tax expense at the debit side. Okay. Now let's look at the second, or the most common one. You see it in a footnote. The footnote. Now, if you see the current year tax in the footnote, it requires two treatments. Number one, you add it to the income tax expense, this very one. So you bring it here. Number two, you add it to your current liability. Why is it a current liability? Because it's a provision. All provisions are what? Liabilities with a certain timing and an amount. So it must be added to it. I'm done with the current year tax provision. Let's move on to the U and O. This is just a summary, and then we jump into question solving. Okay. Now, when we move on to the U or the O, represent under or over tax provision. We call it under or over tax provision. Under or over tax provision. Here, I normally call it a tax reconciliation statement. You know that the current year tax is just a mere provision. So if it's a mere provision, then it's likely that the final one might be different from the provision. So how do you get it? We'll do some calculation here. You compare two items. Number one, tax provided, so much, versus, I call it final or agreed tax. Final or agreed tax. You compare these two. Then the difference is what we call under or over tax provision. That is it. So, and then it's always for the previous year. Please, this again is for what? The previous year. It's for the previous year, it's not for the current year. You can only confirm last year's tax, because that's what they have given it out. This year's own, it's yet to be what? Determined by the tax authority. So if you see the examiner giving you information about last year's tax, so last year's tax that we provided, last year's tax that the tax authority said that we should finally pay, then we are just asking to compute the under or the over. Okay. So now let's perform some small exercise here. What if the tax provided is 30 And then the final tax is what? 35. What will be the final solution? Will it be under or over tax? So here you can see that the tax provided is small, or it has been under provided. So this becomes what? Under provision. That is all. So under tax provision by what? 5. That is all. So let's see. Under means you have to add. So under, can you add it? Over, subtract. Under, you add, and over, you subtract. Under means last year the tax that we provided in our books is lesser than what the tax authority informed us. So we are topping it up to balance the equation. Right. Over, you subtract. We are done. Now, in the trial balance, we sometimes include this in the trial balance for you without informing you in a footnote. So if you see it in a trial balance, this is how it will be. Under tax means it's an expense. So if you see any current tax, the word current tax in a trial balance, if you see current tax in a trial balance, it represents under or over. So therefore, you check the balance. Under means an expense. So if you see current year tax at the debit side, it means it's what? Under tax provision. If you see it at the credit side, it means it is what? Over tax provision. So credit means over tax provision. We are done. Now, with the first two, they are not too stubborn. Current and under tax provision, with regards to them, probably they are not too difficult. The last one, the deferred tax, is the one that normally was. So let's look at deferred tax, and then we start our question solving. Great. We are going to look at deferred tax. Now, if you look at current year in summary, and under or over in summary. Good. So let's also look at deferred tax in summary. Now, the deferred tax, all what you have to do is this. You have to perform a separate workings. This deferred tax that you see here, we call it movement. It's a movement in deferred tax. It's just the changes. So you have to do a separate workings for deferred tax. So perform another workings for deferred tax. It's a nice account that you open in a statement form. Bring the open balance from the trial balance. Open balance is coming from where? The trial balance. Always it's in the trial balance. If it's not in the trial balance, that means it's not given. So public balance go down. If the open balance, if you check the trial balance, there's no deferred tax there, then there's no open balance. Just dash and move on. Leave a space, then underline it, and write a closing balance here. Then you write a closing balance. Okay. So balance carry down. So much. The closing balance, we look at how we can arrive at the closing balance. Then you find the difference between the open balance and the closing balance. That will be here. And that is what you call the P&L, so probably is going to income tax expense. So this is a figure that you come and then put it here. That is the figure. So for income tax expense, by the time you are done, you need two strong workings, these two, and that is all. If you understand this one, we are done. Now, what happened is this. We know how to find this. Let me this, the closing balance. Now, this closing balance here can sometimes be a non-current liability or non-current asset. We'll look at when will be a non-current liability and when will be a non-current asset. That is the closing balance. Okay. Now the closing balance is nothing but the temporal difference times the tax rate. Temporal difference times the tax rate. So let's take note. Temporal difference times the tax rate. That is it. Temporal difference times the tax rate. So let's take note of that. We will look at the temporal difference much detail, or you've gone through it through the previous lecture video. Okay. Now the question is that, let's assume that the opening balance is, let's say, 35. The closing balance happens to be 43. What is the movement? So that the movement is what? 8. When I come here, I record 8. Tell the examiner, maybe working number 3. 8 working 3. Good. What if here happen to be 27? What happened? So what will be the movement? So that means it has dropped. So it has dropped by 8. Wow. So let me make it 30. It has dropped by what? 5. So when I come here, as it is 5 negative, how we get it? The movement. Don't say that, oh, it was negative here. When you come here, it might be positive. No. Just carry as it is there and place it. That's all. Now we have to just look out for how to get this 30, this closing balance, and then that is all. What if we have something like this? And what we are doing, you meet exactly one in your exams. So take note of it. What if here is 35? Here is 35. That means the movement is what? 0. Nothing goes to here. So here dash or 0. Finally, what if this is the situation? First time of provision. Here is 35. Here is dash. So that means, what should I do to the opening balance so that I can get a closing balance? I have to still put 35 here. Good. So here becomes what? 35 positive. Then the last one. Then we are done with all possible means. Here happen to be 28. And the closing balance is dash. We don't have any closing balance of the deferred tax. So that means whatever we have must be exhausted. What should I do to positive 20 so that I can get what? 0. Then it means that I have to subtract 28. When I come here, I also subtract 28. We are done. Now let's learn how to get a closing balance. Don't forget, we said that the closing balance is always either non-current liability or non-current asset. And we said something that was very nice. We said that it is what? The temporal difference times the tax rate. That is all. So the question is, we have to now know the temporal difference. Probably the tax rate will be given to you in the question. So I'll just perform some few illustration between the illustration for the temporal difference. So take note. Now, please, for the purpose of full understanding, can we use the previous lecture or the full lecture? This is a summary. So I might not be able to go into detail. Yes. So can we use the full lecture in the video to grab the full picture? Great. Okay, so let's look at how we can find a temporal difference. How we can find a temporal difference. Now, temporal difference simple means the difference between the carrying amount of an asset or liability and their tax base. When you mention temporal difference is a difference between two items, just compared to, because the word is different. So compare two items and then strike the difference. That's all. Now, what are the two items? Because something carrying amount of the asset or book value or accounting base, they are the same. So, and then versus the tax base. So this becomes the temporal difference. Now, what happens is this. When you have an asset, I'm going straightforward, just a summary. Like I said, to get a full picture, can use the full video. You have an asset. So let us have an asset here. Let's say building. What is the carrying amount of the building? Okay, I'm saying that it's 300. What about the tax base? The tax authority is saying, no way, this building, the value is what? 220. Okay. So temporary, what's the difference? So temporal difference simple means the difference between what? The carrying amount of assets. So we have assets and we also have what? Liability. The temporal difference is nothing but what? The difference between what? The carrying amount of an asset or a liability and what? Its tax base. Tax base simple means the value that the tax authority will carry or the value that the tax authority will agree for a particular item. So if I have a building, in the tax authority's book, what is the value they place on this building? That is the tax base. What is the current amount? The current amount is in our book, the company's records. What is the value of this building? So if there's any difference, that difference is called what? Temporal difference. Don't forget that this deferred tax is an accounting measure, not a legal measure. Okay. So that is over here. The temporal difference is what? It's 80. So that's the temporal difference. It's 80. That is all. So we said that the closing balance of the deferred tax or deferred tax is equal to the temporal difference times what? The tax rate. So over here, if the temporal difference is 80, let's assume that the tax rate is 25%. What would be the deferred tax provision? And the deferred tax provision will be 20, right? Perfect. So that would be 20. Great. So this is how. So this 20 becomes what? The closing balance. That is all. So always find the current amount of the asset and find the temporal difference. Sorry, and find the tax base. Okay. Now let's go into detail to end the game and start our question. Now, two things will happen. Either the current amount will be what? More than the tax base, or the tax base will be more than the current amount. So what happens is this. If the current amount is more than the tax base, then that temporal difference is called taxable temporal difference. It is called, let's name it here, taxable temporal difference. So take note. So if the current amount is more and the item in question is an asset, okay, so we call that temporal difference or taxable. And taxable simply means non-current liability. That is all. So in this case, this 20 becomes a deferred tax liability. Why? Because this temporal difference is called taxable temporal difference. That means in future, the tax authority will call us and tax us more in future. That is the implication. Okay, so that's the non-current liability. Now, what if the current amount is what? Rather less than or lower than the tax base. So this one is taxable. So let's assume that the current amount of a certain asset, let's say plant, is let's say 800, but the tax base is let's say 1,200. So what will be the temporal difference? Now this temporal difference is what? 400. Now, if it's an asset, the item in question is an asset, plant is an asset. So please, it is your duty to know our asset that we have, both current and non-current of them are assets. So what happens is this. Now, this difference, we call it what? Deductible. Deductible temporal difference. Deductible temporal difference. It means that it is what? Non-current asset. It is non-current asset. Deductible temporal difference simple means is what? Non-current asset. We call it deferred tax asset. That means in future, the tax authority will deduct it, will subtract it, they will subtract it before taxing us. So like it will reduce our tax. So it's an asset to us. That is all. Now, please, you don't need to learn everything. Just learn first one. The opposite is true. Now, if it is a liability, let's say a loan or payable, with a liability, and the current amount, let's see the same figures, is greater than a tax base, then the difference, we'll call it, what to be the name? And it should be what? Deductible. That is all. So this will amount to what? 80, but deductible. That is it. You have to take note that this becomes deductible temporal difference. Then, if it's a liability, and then the current amount is rather less than the tax base, then that becomes what? This is 400, but it becomes taxable. That is all. It becomes taxable. So let's take note. And taxables are what? Non-current liability. Deductibles are what? Non-current assets. We are done. So let us back with the word illustration. So first, as usual, I'll start with my question solving from the material. Go through them, then And about to finish, then we enter into deeper waters by solving of the past exam questions. So let's see if we can start with the questions. But before that, if you do have any suggestion, addition, or questions, kindly let me have them. Now, the one issue is this. We said that the deferred tax is just the temporary different times the tax rate. Now, the tax rate must be one, the current tax rate or tax rate subsequently enacted by the government. Great, so that is the tax rate that we are interested in. Now, let's see with the question solving. So I'll project some questions, then you try them for me. I wish, okay, let me solve first, then you do the second. I'm solving this particular example. This very one. Required. Calculate the tax charge that will be shown in the statement of profit or loss for the year ended 31st December 2018. Okay. If the amount that was actually agreed and settled with the tax authority in respect of 2007 was 165,000 and $140,000. This is the question. They say the target PLC has estimated its income tax liability for the year ended 31st December 2018 as what? As 180,000. Okay. So what was that figure? That becomes what? The current year tax. So now when I'm solving income tax expense, just start examining. Just write these things down. CUD. I'm doing the A. What is the C? What is the U? What is the D? Over here. So according to the question, the current year, they say we should determine the income tax expense for 2018 financial year, so 2018. But the current year is 2018, but they're giving us information for 2017. That tells us that either it's the open balance or it is the under or the over tax. Good. So the 180,000 is the current year. The target PLC has estimated its income tax liability for the year ended 31st December 2018 at what? 180. So that's the current year tax. So let's go and put it down. C, we are looking for the income tax charge. So first, current year. Year tax is $180,000. Then let's see if they will be under or over. And they're saying that in the previous year, that's 2007, the income tax okay, so now in the previous year, that's 2017, the income tax liability had been estimated as what? As $150,000. So the tax provided is what? 150. According to A, the amount, if the amount that was actually agreed, so there's agreed there, and settled with the tax authority in respect of 2017 tax was A 165. So according to A, then it means that the company have what under provided, right? But they make a provision of 150. But the tax authority say no way, you are paying what? Something more than that. Agreed. Okay, so that is it. So what we do is yeah, we go to the board. Provision is 150 and the final one is 167. Right here under tax provision, open a bracket, 165,000 minus 150,000. So that will give us 15,000. Under you add, this question is no deferred tax. Under you add, over you subtract. You add the two together, get 195,000. So that is it. So that was the A. Let's go to B. The B, the final tax agreed is 140. Okay, so that is it. So it means that if you are to solve the B, then it means that the tax final tax is 140. So the tax estimated is still 150. So it has been overestimated by what? 10. So this is A. Let's do the B. So B, I'm just put B here. So the current year tax is 180,000. It's not changing. Just that year it has been over provided, not under. So over tax provision into bracket, the 150,000 minus 140,000. See, here we are just finding the difference. It doesn't matter which one comes first, which one comes first. So you get 10,000 over subtract under you add. So finally, the tax will be 170,000. So that's the income tax charge for this illustration. Income tax charge. Okay. Now, if I do one, you do one to one mapping. Let's see if the next one goes. Okay. Then you try it. Okay, so let's see the illustration 1. Illustration 1. Okay, so illustration 1. An entity acquired a new computer for 1,200 cedis in the year. The entity depreciated the computer over 3 years in accordance with IAS 16, property, plant, and equipment. Yeah, in accordance with the IAS 16, property, plant, and equipment. However, the local government provide a tax incentive to businesses for investment in new computers, in new computer equipment, and therefore the full cost of equipment is allowable for tax purposes in the okay. So how do we find the temporal difference? So let's use this particular question. This is an asset. They acquired computer. So let's go to the board. They acquired computer. They acquired computer. So right here, current amount and what tax base. And it becomes the temporal difference. It becomes the temporal difference. And the asset in question is what? Computer. What is the current amount? Now the cost of the asset will be 1,200 agreed. Where accumulated depreciation will be, they say they depreciated over a 3-year period. So 1,200 divided by 3, and that will give us 400 agreed. Okay, so here will be the depreciation is 400. You take it off, you had 800. That's year 1. Let's go to the tax base. Yes, the tax authority also see the value of the building accurately 1,200 to cost. What about the written down or the capital allowance? Now the question said that they write the entire cost, the full cost of. So the full cost is what? The full cost is 1,200. You take it off. Current amount is now 0. Or the written down value is 0. So what's the temporal difference? Current amount minus the tax base. The temporal difference is what? 800. Temporal difference is 800. That is it. Now let's assume that the tax rate is 25%. Let's just assume. What is the deferred tax? Then deferred tax will be, it says the temporal difference of 800 times 25%. And that will give us 20. Okay. So that's the first year. This is how the year 1 will look like. Let's go to year 2. So we're done the first year. Let's go to year 2. Year 2. With year 2, what's the cost of the asset? The cost is 4,200. What is the accumulated depreciation? Now it will be 2 years. 400 plus 400, making 800, right? Accumulated depreciation. So you get what? 400. What is the open balance of the written down value for it? Is 0. Capital allowance, 0. At the end of the day, everything is zero. So what's the temporal difference here? Again, the temporal difference is what? 400. Now let's go to the last year. Last year, what do you think will happen? The third year, the asset will be scrapped off. So in the third year, both the current amount of the asset and then the tax rate will be zero. So the last year, that's year 3, the asset open balance, the cost will be, the cost will still be at, the 1,200. Then accumulated depreciation will also be what? 1,200. How? It is this 800 plus the charge for the year accumulated to 1,200. So net answer is from 0. Meanwhile, here the asset has been scrapped off long ago. So basically, that is the end of the game. Now, when you do this, you are not done because at least convert the temporal differences into what? Into the deferred tax calculation. So you multiply all of them by the tax rate. Let's just assume that the tax rate is 25%. For financial report, you do not assume any tax rate. You are not doing taxation here. They don't now give you all the tax rate. Necessary tax rate, they don't want to give it to you. So if the tax rate is 25%, so this time is 25%, which is equal to 20 Ghana. Times 25%, which is equal to 10, right? Okay, so let's prepare the deferred tax account. Let's prepare the deferred tax account. The deferred tax account will look like this. This is the deferred tax account. We start as usual, year 1, year 2, and year 3. We start with the opening balance. This the first year, that's your first time, so no opening balance, cash. Just leave a space here and line it as usual, write the balance carry down or the closing balance. So for year 1, who can tell us the closing balance for year 1? What's the closing balance? Okay, so the closing balance is 20. Open balance is dash. What happened? This is P&L. Well, simplified CIT. That is the corporate income tax. So it must go to income tax calculation. Okay, so what will be the movement? So here must be 20. If I'm preparing a P&L, for instance, C, U, and then D and O, I only have what the C for now. Okay, so let's move on to the next assumption. Now let's go to the year 2. This is the closing balance. You can't put in balance here, right? Okay, then what's the closing balance for that period? So you see what's the closing balance of the deferred tax? 10. That's it. I think that's will be 10. So what should I do to 20 so I can get 10? What should I do to 20 so I can get 10? What will be the entry? Okay, so let's answer it. Good, negative 10. I think that. So just do this way. Wow. You don't want to see negative attached to figures in account. Either use bracket or use the statement version. Then finally, what happened is this one comes as open balance of 10. Closing balance is what? Dash. Because and then it's whatever remains should be recouped. So what should I do to this so that I can get the then the same figure comes, but I will subtract it. So that's the first example and first illustration. Okay, so illustration 2 suggests that an entity has an asset in this statement of financial position representing interest receivable of 500. Although the interest will not be received until after the end of the reporting period, it has been earned in a current period and therefore has been recorded as income. So how do you treat this? So interest receivable. So first of all, ask yourself, interest receivable, is it asset or it's liability? So tell the examiner that interest receivable is an asset. So therefore, the current amount of it will be interest receivable, which is 500. What about the tax base? Zero or dash. So therefore, there's a what? Temporal difference of 500. If I know the tax rate to be 25%, then I can determine what the income tax expense. Okay. Do not assume any tax rate. The examiner have to give it to you. Fine. Now let's continue the game. Let's go to illustration 5. Illustration 5. Okay, so illustration 5. Okay, so it says that an entity operating Moldova and enters into a long-term contract to build a motorway in that country. During the year ended 31st December 2007, the entity recognized 4 million, that is the C currency. So 4 million of income on these contracts in profit or loss for the period, although it does not expect to receive the related cash until the year ended 31st December 2009. So probably exactly 2 years. Okay. Under the tax rules of Moldova, tax is charged on cash receipt basis. Full stop. Now it continued to state that the tax rate for businesses in Moldova was 30% in the year to 31st December 2007. But the government has voted in favor of reduction to 29% for 2008. Then there is currently a rumor that the rate will drop to 28% in 2009, but no announcement has been made for this rumor. How do you treat this? So first, there are three tax rates in this question. How are you going to use them? And second, there was 4 million income yet to be received. So that will still be an asset, right? Okay, now let's go to the board and do it together. So first of all, tell the examiner that the income that is yet to be received, what is the current amount of such income? What is the tax base? It's going to 4 million. Tax base is dash. So therefore, so contract revenue. So that will be the temporary difference of what? 4 million. Now let me the tax rate that we should use to determine this deferred tax. Great. Now the tax rates are three here. We do have 28, 29, and 30. Let's write their names. This is rumor. This is enacted. This is enacted. Oh, sorry, stop coming. Let's write them here. Great. This is what rumor. This is enacted. This is current tax rate. Current. So which one are you going to use to, or what are you going to use rate for? This is for enacted for 2009, where this money is expected to be what? Received. So the question is this. The rumor, cancel the rumor out. You don't use any rumor. So rumor, any tax rates or tax as a result of political campaign. If any political party promise a tax rate that when I come, I'll reduce the tax rate to, let's say, 25%. Please don't use it for any calculation. No, it's a rumor. Enacted by the parliament. Yes, you can use it. It has been enacted by the parliament, but has not been taken effect. So that is it. Now, this tax rate enacted, use that one to calculate for the deferred tax. So use this one for the deferred what? Tax calculation. This is the current tax rate. Is for calculation of the current tax. Current what? Tax. So take note, that's all. So this deferred tax of 4 million, we have to multiply by the 29%. So times 29% to arrive at what? The deferred tax provision. That is all. Rumor should be out. We don't deal with rumors. We deal with enacted or subsequently enacted by the government. Great. We are done with that particular one. Now let's go straight to the tutorial questions. The rest are on. Now there's a revaluation here. We call it deferred tax on revaluation. However, I will treat this after the IAS 16 when we are done with revaluation. But we should understand revaluation first. So for this section, I'll jump it right after the revaluation. I'll look at it. Now let's continue with the question solving. Okay, so let's go to and look at changes in the tax rate. How do you treat changes in a tax rate? Changes in tax rate. Now, if the financial statement had already been prepared, any change in the tax rate, it is what? Non-adjusting event. Non-adjusting event. Take note that if the financial statement has already been prepared and then they've changed the tax rate, then such transaction becomes what? Non-adjusting event. Good. So just that at the time of preparing the financial statement, if the deferred tax calculation or if there was an enactment or they've passed a bill to propose a new tax rate, good. For that particular enactment, we can use the tax rate to calculate for what? The deferred tax. So that is how we should treat it. Okay, then we can continue again to move on. So we are done. Now we can go to tutorial questions. So I'll start solving this particular question. This is a tutorial question 1. So let's look at tutorial question 1. What's the requirement? Require calculate the deferred tax provision as at 31st December 2015. You are just looking for the closing balance. So it means that we have to get a temporal difference and multiply by what? The tax rate. Look at how we will solve this. We've now started the real questions. So okay, now let's go through the question. So an entity have the following assets and liabilities recorded in its balance sheet as at 31st December 2015. So all the items are there. Property, plant, equipment, inventory, trade receivable, cash, trade payable, all of them are there. Great. So now let's see the notes. The value for tax purposes for property and for plant and equipment are 7 million and 4 million respectively. Okay. So probably that's what the tax base. Correct. The next one states that the entity has made a provision for inventory obsolescence of 2 million. You know, the tax rate will not, the tax authority will not agree with this. So that means the tax base will be different. Good. Which is not allowable for tax purposes. So we have to reverse it. So for tax purposes, any provision made, what do? Reverse it so that we can get the actual figure. And to the inventory is sold. Correct. Furthermore, an impairment charge against trade receivable of 1 million has been made. So that means this trade receivable, they have subtracted 1 million from it. That the tax authority will not agree. So what do? We have to add back in order to get what? The tax base. And this charge does not relate to any specific trade receivable, but to the entity's assessment of the general, right, of overall collectability of the amount. This charge will not be allowed in the current year for tax purposes, but to be allowed in future. Great. Income tax is 30%. Now, it also means that the inventory, they've already written 2 million down. So the actual inventory figure will be what? The actual inventory figure for tax purposes will be 6 million. That is all. Then you find the difference. So here, I want it in column form, like how we're going to do. So we are calculating for what? Deferred tax provision. So we are calculating for deferred tax provision. Put in a 9 table. Bring the asset or liability here. That examiner. The current amount. That examiner. The tax base. That examiner. The temporal difference. We are done. So let's copy the items in here. So item number 1 on the list, property. So property. And then the carrying amount is 10 million. Don't forget your currency, it's in millions. From the plant and equipment. So plants and equipment, also 5 million. Then let's move on to inventory. Inventory happen to be what? Current amount is 4 million. Then from there, trade receivable also happen to be 3 million. From there, we go to trade payable. This one's coming from the question direct. Trade payable also happen to be 6 million. Cash also happen to be 2 million. That is all. Now let's go to the footnote to go and look for the tax base of this item. So let's go to the footnote to look for the tax base of these items. The tax base of this item. Now they said the value for tax purposes. The value for tax purposes of property and for plant and equipment are 7 and 4. So property is 7, equipment is 4. So 7 and 4. Let's go and put them in. So million, 7 and what? 4. Let's continue the game. Continue to say that the entity has made a provision for inventory obsolescence of 2 million. Tax authority will not allow. So they have already subtracted 2 million before they arrive at this 4. So that means for tax purposes, they have not seen 4. They have seen what? 6. Thank you. I like that. Because tax authority have seen what? 6. That is it. They have seen 6. Let's continue the game. Which is not allowed for tax reward. Furthermore, an impairment charge against trade receivable of 1 million. Okay, so they've trade receivable, they've also subtracted 1 million from this figure. Tax authority will not allow. So let's add back. So let's go 4 million. And let's continue the game. We are done. Now they are saying that the income tax paid is 30%. Oh, then that's all. The rest, that means there's no difference. They have the same tax base and then the current amount. So trade payable carry the same thing here. Cash. If you have a cash of 2 million, can the tax authority tell you that, oh, this one is not up to 2 million, no. This one will not sit at 2 million, no. That one is the same 2 million. So some of the items, they have the same value. So let's find a temporary difference. So let's go. Temporary difference. If it is taxable, let's make all taxable positive. So all taxable, let's make them what? Positive. All deductible, let's make them negative. That's all. So what will be the temporary difference of the property? 10 million minus 7, so that gives us 3. 5 minus 4, that will give us 1. All of them are positive because they are what? Taxable. Taxable means the current amount is what? More than a tax base. Inventory 4 and 6, 2 is deductible. Why? Because the current amount is less than the tax base. Trade receivable, it is what? 1. It's also deductible. What again? Trade payable 0 or dash. Cash also 0. Put all of them together. What's the total? So the total carrying amount will be, in fact, subtract the trade payable, put it in brackets here. So you can get a net asset. So the total will be total net assets. You add all. So 10 plus 5, 15 plus 4, 19 plus 3, 22. Minus 6, 16 plus 2, 18. Good. So that means here will be 17. If you do it well, yes, 1 million. Agreed. So let's see. 7 plus 4, 11. Plus 6, 17. Plus 4, 21. Minus 6, 15. Plus 2, 17. Great. Then like that. So the temporary difference is what? 1 million. So what will be the deferred tax provision? Okay, so kindly calculate the formula missing. Deferred tax provision. Have you seen? Today I've done well. Solved almost all the questions though. So it's your turn now to look out for or do the deferred tax provision. Now let's continue the game. If the tax rate is 30%, then we can calculate the deferred tax provision as follows. Or you can calculate it as this. So you just have to multiply the 1 million by the tax rate. That is all. So therefore, the deferred tax provision will be 4. So therefore, the deferred tax provision will be deferred tax will be equal to 1 million times 30%, which is equal to 0.3 million. That's all, or 300,000. So perfect. So that's 300,000. Great. Okay, so let's continue the game with the question solving. I have some few questions to illustrate, and then I'll move on to the next standard. Okay. So let's see question. Question 3 is about revaluation. So probably after we are done with revaluation, I will explain how the tax should be treated. But we need to know how to treat revaluation first before we can do the tax on it, which will be the next standard. Okay, so let's see this particular question. Question 4. Question 4. So question 4, an entity has spent 600,000 in developing a new product. These costs meet the definition of intangible assets under IAS 38 and have been recognized in the balance sheet. Local tax legislation allows these costs to be deducted for tax purposes when they are incurred. Okay, so it will be expensed. So that's expensed, but it's an asset for this organization. Therefore, they have been recognized as an expense for the tax purposes. At the year end, the intangible asset is deemed to have been impaired by 50,000 required. Calculate the tax base of the intangible asset at the end of the accounting year. At the end of the accounting year, what is the tax base? What is the tax base? Okay. Now, the value that the tax authority will place on this intangible asset will be 600,000. And that will be the one that they've expensed it, which is like 600,000, basically. The 600,000. However, in the company's book or the current amount at the end of the reporting period or the accounting year will be 600,000 less the impaired amount or less the impairment, which is 50,000. So therefore, the current amount is 650, but the tax base is what? 600,000. The tax authority have seen only 600,000, but in the book it will be 550. So therefore, there's a temporary difference of what? Temporary difference of 50,000. That is all. Okay, so we'll continue again with the question solving. But you have to finish all of them. Oh. Question 3 is revaluation. And then question 5, no, it's on subsidiary. We'll look at it. The last question, when we are done with the revaluation, to be your tryout. So take note. The last question over here. Good. The last question. Okay, so we are done with the first set of the question. I also have some special questions for you that we have to look at them. So now let's go to the special questions. They are just questions coming from your examiners. Okay, so the very first question will be a trial work. That one, I'll take it. Everybody have to, okay. They want to have the revaluation. Good. They want to have the revaluation. So that means we cannot do that one now. And it's the corporate reporting question. So it's a bit powerful. So kindly take note of that. So let's go to question 2. So let's look at question 2. Question 2. In accordance with IAS 12 income taxes, deferred tax liability are the amount of income tax payable in a future period in respect of taxable temporal difference. Perfect. Perfect. That's a perfect definition. Required. Explain temporal differences. What is temporal differences? So temporal differences. Temporal differences. That is another temporal differences. It's just the difference between the carrying amount of an asset or a liability and what its tax base or their tax base. Let me explain into detail a bit. When we talk about temporal difference, we get it from the two profits. We have what we call accounting profit. Just that the accounting profit is in the full video. So when you watch the full section, you get this explanation in. We have the accounting profit and taxable profit. So I call this one accountant profit and taxman's profit. This is the profit before tax. And this one is the tax or the taxman's profit. The income tax liability will be calculated on this figure. Perfect. Now the question is, what causes this difference? What causes the difference between the accounting profit and then the taxable profit? Accounting profit is the profit determined in the tax books. So in the yes, the second set of the question I've not uploaded it, so probably I have to do that. Okay. Now that is it. So accounting profit is a profit determined in the accounting books. That's the profit before tax. Using what? The IFRSs. After using the IFRSs, accounting standards. Taxable profit is the profit determined by the tax authorities using what? The local tax laws. After examining the company's accounts, in which the income tax liability will be calculated on. So the income tax liability will be determined on what? The taxable profit. That is it. Okay. Now these ones, they are not the same. There's some differences between them. The difference are two. We have what we call the permanent difference, and we have what we call the temporal difference. We have the permanent difference and then the temporal difference. You should know probably the difference or like their meaning. Good. So temporary difference. Good. Let me just provide a brief distinction between them. So that when you see them anywhere, when the examiner asks, you will find. Even though it has been defined in the standards, it has been defined in the IAS 12, so it's not a definition. I'll start with permanent difference. Permanent difference, we are saying that a particular item is allowed by one party and is allowed by the other party. For instance, a particular item or transaction, the accountant will include it, but the tax authority will disallow it. That is it. So that's a permanent difference. An example, to create what you call permanent difference. So permanent difference is one-off item. It's just one-off item or transaction, which is allowed by one party, maybe the accountant, but disallowed by the other party, that is the tax authority. Good. So examples of such items are: one, entertainment expenses. So if you incur entertainment expenses, the accountant will add it to the what? The admin expenses. But the tax authority will not allow it, and therefore will disallow. So this transaction will create a permanent difference between the profit reported by the company, that's the accounting profit, and the profit determined by who? The tax authority. Good. So we are down with permanent difference. Let's go to temporal difference. Now, giving reference to permanent difference. With a permanent difference, let's put accountant here. Let's put the tax authorities also here. Permanent difference, one party see it, other party do not see it, fine. But with a temporal difference, all of them see the same item, all of them allowed. So temporal difference, all of them, both the accountant and the tax authority allow. Let me ask you this question. Have you seen the company's office building? The company sees as what? Office building. Can the tax authority state that they don't see the building as building, but they see it as what? Some group of stones? No. Or it's a stand. They can't say that. So when you have a building, the tax authority also sees it as building. The company also sees it as what? Building. Fine. So here with the temporal difference, all of them, or both parties, both the accountant and the tax authority, see it as what? As a particular item, but the timing is different. The time that the accountant sees it as building, it's not the same time that the tax authority also sees it as building. Yes. The time. So they have a timing differences. So the differences is about timing. So temporal timing differences. So let's give a practical example. Now, if I have a building here, let's say the value is 50 million. Number of the useful life. Let's say to go for this building, there should go for 40 years. But the tax authority also see it as okay, 50 million, no doubt. This building, no, this one it should last for 10 years. So right after 10 years, your building vanished from the tax authority's book. Yes, because to be scrapped off. Then until 40 years, the building will still be with you in your books. But after 40 years, it vanished. So it means that right after 40 years, there's no difference again. It has vanished already in tax authority's book and it's now moving from the company's book. So that is what we are talking about. So let's assume that here, at the end of the year, what will be the current amount? At the end of the year, the current amount will be, let's assume that the current amount over here is what? Let's say 45. The current amount will be somewhere 47. I'm just assuming, just an assumption that the current amount is 47. Here is 45. So temporal difference, in short, if you want to define temporal difference, the standard defines temporal difference as this: is the difference between the current amount of an asset or a liability and their tax what base. Their tax base. That is all. So temporal difference is just the difference between current amount and the tax base of an asset or a liability. We are done. Let's move on to the next question. Okay, so this one, this is a trial. So the B parts, just 3 minutes to try. 3 minutes, 3 solid minutes. Start work. Thank you. Okay, great. So now let's work it together, and I hope you pause the video, or you can do it now before check the answer. Okay, so require explain the treatment. It says explain the treatment of the above transactions in the financial statement of Dansuman Limited for the year ended 31st March 2019 in respect of what taxation. Great. IAS 12 income taxes set out guidance for dealing with under provision and over provision of income taxes by the reporting entities. During the year ended 31st March 2019, Dansuman Limited finalized and paid a tax liability for corporate tax on profit for the year ended 31st March 2018. Relax. Anytime you see the examiner quoting tax and quoting last year, the current year is what? 31st March 2019. They are telling us the final tax that have been paid, final or agreed. Then it means that the examiner is just calling you or drawing your attention to under on over tax provision. And even beside the caption or the heading capture under and over tax provision. So they are calling you. Under and over tax is calling you. Have you seen? When you hear these words, then they are calling you in. And what do? At an amount of 21 million. So that's the final tax or agreed tax, 21 million. It had previously made an estimate or an estimated provision for corporate tax of 25 million. So that's the tax provided in the financial statement for the year ended 31st March 2018. The directors estimate the liability for the year ended 31st March 2019. That's the current year, 24.5 million. So how do you calculate this? So tell the examiner that the if we are looking for the income tax expense, we need 3 items, C, U, D. In this question, we have the current year tax or the current tax provision is to be, let's write those here, 24,500. Agreed? And here, the tax provided. Tax provided was 25 or 24 million. Let's go there and see. Pick it again. The final tax is 21. Tax provided is 25. That is all. So tax provided is what? 25. And final tax and agreed is what? 21. So it means that it will create what we call over tax, right? So over tax provision. So here we will not write you, to write over tax provision of what? 4,000. Take it off. There's no deferred tax in this question, so no deferred tax. It's not compulsory for them to give you all the 3, no. So no deferred tax. So therefore, the income tax expense for this particular year will be 20,500. Perfect. So income tax expense taken to P&L. Income tax expense. into bracket, taken to where? P&L. Second, this figure should go to where? The financial position as what? Current liability. That's all. We are done with this particular question. So explain to the examiner that the tax provided for last year and then the tax paid for last year will be adjusted to arrive at what? Over tax provision, and therefore will be subtracted from the current year tax to arrive at what? The income tax expense. So that is the explanation. And the current year tax will be taken to the financial position. Then as a what? Current liability. We are done. So on that note, we are done with the income tax for the first half. You'll see it again in questions. So, but before that, I will project three. I will give three practical questions of income tax 3. So when I solve the 3, I'm done. So I'll go through the list, the past questions, and then pick some 3 questions in there for you to see how it will appear. So, okay, so the first one I'll look out for is Parasol Limited. You can see that you have something like this here. There's a trial balance in it. You have just deferred tax here. So that's the open balance of the deferred tax, 2,300. Then you go to the last footnote. It said that the corporate income tax payable estimated on profit for the year is 3,500. Probably that's the current year tax. And then an amount of 1.2 million is to be transferred to the deferred tax account or deferred taxation account. So here the examiner have solved the deferred tax for you. He didn't give you any tax rate, no temporal difference. He has done it for you already. So just pick it free of charge. Okay, so in this particular question, it look like this. So this is the number 1 out of the 3. Okay, so your current year tax, we are looking for the income tax expense quickly. Current year is what? 3,500. There's no under and over, but there's a movement in deferred tax, which is 1,200. So therefore, the closing balance becomes what? 4,700. Perfect. Again, then open deferred tax account. Deferred tax account. Okay. Open balance from the president is 2,300. Go to the closing balance. Now there's a movement. They have given us the movement. Bracket the movement, which is 1,200. That will give us the closing balance. So what's the closing balance here? The closing balance will be 3,500. Now take this one to non-current liability because it's a deferred tax liability. Again, take this one to the P&L as an expense and take this one to current liability. You are done for this particular question. Now the next question. I'm scanning through 3 random exam past questions. Okay, so the next one I'll look at for, we call it Zillow. Zillow. So Zillow, let's look at Zillow too. Zillow Limited. Zillow Limited. Good. So Zillow. 3 random. For me, I'll go to Bix. Bix. So let's scan to the trial balance first and see what is in there. In this trial balance, I can see tax, deferred tax, 5,200 here. Agreed, 5,200. So that's the open balance of the deferred tax. Let's go down. If you check the notes 4 here, the directors have estimated that the provision for income tax for the year ended 31st December 2015 at 8 million. Let's confirm the year in question. The year in question is 31st December 2015. Fine. So therefore, if they are mentioning the same year to us, then that is the current year. But if they should have mentioned 2014, it is what? Under or over previous year. So take note of that. So current year is 8 million. The deferred tax provision as at 31st December is to be adjusted through profit and loss to reflect the tax base of a company's net assets. To reflect that the tax base of the company's net asset is 12 million less than the current amount, and the tax rate is what? 30%. So how do you treat this? So in short, they are just telling that the company's net asset, the tax base is 12 million less than what the current amount. So they find a temporal difference. That means the temporal difference is 12 million, and therefore the accounting base or the current amount is what? Is higher than the tax base. That's what they are telling us. So just multiply this 12 by the 30%. That will give us the closing balance of the deferred tax. Go to the trial balance to pick your open balance of the deferred tax. That is all. So deferred tax is here. Open balance is what? 5,200. So let's solve the question here. I just have to clean this one. This question too, there's no under and over. So that in my next question, there must be under and over. Current year tax is 8,000. Deferred tax, have to come and perform the workings here. Open balance is 5,200. And then they are saying that the closing balance, we just have to multiply the 12,000 by the tax rate of 30%. And that will give us 3,600. So you find the movement. So what's the difference between 5,200 and 3,600? Now, the examiner says something here so important. You know that we have to find current amount and tax base, right? But here the examiner said that the tax base is lesser than the current amount by 12. So would this 12 be a taxable temporal difference or deductible? So it is what? Taxable. That's perfect. If the current amount is higher than the tax base, then it is what? Taxable. So take note. But the examiner wanted to confuse you and said that, okay, the tax base is what? Lesser than the current amount. So just find the difference between these two. So that would probably give us 1,006, right? Okay. So that gives us 1,006, right? So 1,006. Then I have to subtract. So I'll put in brackets. When I come here, I'll subtract 1,006 from this figure. At the end of the day, whatever I get, that becomes the income tax expense. That's all. That becomes income tax expense. That becomes income tax expense. Okay, so that is that. Let's see Bix. If Bix 2 will give us and then over, so that I'll move on to the next question. Okay, I hope everyone gets it from me. Okay, so Bix is here. Very interesting question. This is Bix. 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 So let's come to the trial balance to know. Okay, so there's income tax here and there's note 4. Okay, we'll go and read note 4. Thank you, examiner. Again, there was another deferred tax. I can see deferred tax too. Have you seen it? Yes. Another deferred tax, note 4. So let's go and read note 4. Straight to note 4. Okay, so they are saying that the estimated income tax on profit for the year ended 31 December 2018 is 4.5 million. Powerful. So that's the current year tax. So you put it down, current year tax. During the year, 4.2 million was paid in full and final settlement of income tax on profits for the year ended 31 December 2017. Good. Let's go and check the current year. What is the current year? The current year is 31 December 2018. So they are telling us final tax paid for last year, which is 2017. So what is calling you? Under or over tax provision is calling you when you see that they are quoting those terms. Fine. The financial statement, the financial position as at 31 December 2017 had included 4.4 million in respect of these tax liabilities. Okay, so the provision made was what? 4.4 million. But the final tax is what? 4.2. So will it create under or over? The provision made is 4.4, but the final one or the agreed tax is what? 4.2. So I think the provision is more. So it will be what? Over provision of 0.2, which is 200. And we said that this over of 200, it must reflect in a trial balance. So let's go to the trial balance. Now, if you go to the trial balance, we said that if you see current tax or income tax in a trial balance without any footnote, it represents under or over. We said that if it's a debit side, it is under. If it's a credit side, it's over. This 200 is at the credit side, so it means that it's what? Over. And that is the note that we read. So the difference between the 4.4 million and the 4.2 million is the one that has been stated on the trial balance there as 200,000. So that is it. So there's over tax provision of what? 200,000. That is all. Let's move on. As of December 2018, the carrying amount of the net asset of Bix Limited exceed their tax base by what? 35.8 million. So what do you have to do? We just have to strike. They've given us a temporary difference to be 35.8 million. So strike 25% on it and then you just pass the entry. So in summary, this is how the entry will look like. Let's go and pick the opening balance of the deferred tax. I think it was 8,000. Great. And then the current year tax provision too was 4.5 million. So in short, this is how it will be. So the current year tax provision is 4,500. Here there's over tax provision bracket 4.4 minus 4.2, which is giving us 200. We say over, we subtract deferred tax. So deferred tax, we have to go and calculate deferred tax. So let's calculate it here. So deferred tax, opening balance is 8,000 from the trial balance. Closing balance, just have to calculate 35 point It should be 35.8 then. So 35,800 times. Let me go and pick that information again. The tax rate is 25 and then the temporary difference 35.8. Good. So let's see, times 25%. So that becomes the closing balance. So let's do the calculation together. So 0.35 times 35.8. That's 12,530 average. 12,500. No, it's not. But I use 35.25 times 35.8. It should use 14.5 or so. Okay, so 8,950. So this is 8,000. Which I can do something with. Going to be 35.8 times 25%. 8,950 agreed. So what's the difference? So that's increased by what? 1950. So this is it's going to income tax expense. So come and put it here as 1950. You sum them up. So that this 1950 plus so 1950 plus 4,500. Now less 200. Any answer for me? 6250, right? 6250. Then when we come here, you are done. So this taking to P&L. Taking to where? P&L. So in your profit and loss, this one goes as income tax expense. This figure goes to the balance sheet as current liability. This figure goes to the balance sheet as non-current liability. You are done. That is all. So in income tax, we need three items: the non-current, current, and then the what goes to the P&L. We are done. Okay. So this is how far the good Lord bring us for that of the income tax IAS 12. So moving on with the standards. Great. So thank you very much for coming. Kindly subscribe if you have not done that.